welcome to Charting the Markets on this Wednesday, 7th of February 2024, as we continue to monitor what's going on in terms of Fed funds futures and whether or not the Federal Reserve is likely to cut interest rates in March. Now, that certainly now seems not to be the case. I think it's as low as 16% if you look at expectations in the market of any move in March on the way down. So it's now been pushed out to May. The big question is are the markets going to have to swallow again and see that taken further on out with all that's going on fundamentally? Let's take a look at some of the charts now with our guest in this next 15 minutes. It's Serge Berger from thesteadytrader.com. Serge, welcome. We've spoken to you about this before, but it seems like the extra weight is continually added to the dollar. As of the time of speaking, we've got a small retracement, but in the grand scheme of things, the bottom line is that we've got dollar strength coming through. And I guess it's all part of this idea that the markets are going to have to expect the fact the Fed aren't going to move as quickly as they first thought. Is there much more upside, do you think, to the dollar positioning? What's your thought as a trader in all this discussion point?
Hey, Jeremy. Yeah, I think markets are, and when I say markets, I think the equity market's a bit offsides, but it has to do with with fund flows, with CTAs chasing performance, trend following, call it what you will. And they typically kind of tend to just do that until the trend changes. So you kind of need a couple of ugly days for that to end. But yeah, I mean, look, the way 10-year yields acted last week is really quite remarkable. I have a chart here if you guys want to show that. Last week after the Fed, we saw 10-year yields go from about, call it 4.2%, I'm rounding up here, down to about 3.8, back to 4.2. In bond market terms, that's like a VIX at like 50. It's very volatile. And I think people haven't quite grasped what that means. To me, the line in the sand is about 4.2%. And I know you were addressing the dollar, but I think the dollar index here is doing something very similar. So what I have here is a dollar index chart, and we got buy signals on dollar versus all sorts of currencies last week, or just a few days ago, versus yen versus kroners, all sorts of things. So the dollar trying to break out here. In fact, it had a breakout attempt a couple of days ago, consolidating now. I think anything in the dollar index above 104 or in 10-year yields above 4.2, if that can sustain, the equity market's not going to like that. And to kind of show you this maybe a touch better, I'm going to bring back the 10-year chart. And what you can see, if I put up the equities, the equity line here, the S&P 500 is in orange, just so people can kind of get their head around the inverse correlation. So you can see how the equity market, which is the orange line, bottomed in late October, early November last year. You can see what 10-year yields did. They topped. So 10-year yields have basically screamed lower. The equity market rallied. But now the dollar is starting to put in a higher low and potentially a higher high versus that 4.2 level. Yet the equity market, we're down to about 4 stocks in the equity market, by the way, doing basically not caring. So we're walking a thin line, right? We don't want to be grizzly bear. Everything's bearish in the end of the world. It's just a matter of, really fewer and fewer stocks are carrying this rally.
Yeah, you mentioned stocks. We'll take a look at a couple of stocks I know will be of interest in a few moments' time. But I want to follow up on this picture with this dollar basket and expand it out to what many FX traders really do regard as the mother of all trade, and that's the euro-dollar trade. And we've seen this big retracement, haven't we, over the last 3 or 4 weeks or so, where we've seen a near total retracement. I think, if anything, it's actually hit that low that we had the back end of last year. I'm looking here at a chart that takes us back to the lows back in the 8th of December. For me, as a trader, I was taking this down below that retracement level. And my next price target was down at 105.17. I'd be interested to know what your thoughts are in terms of the direction of this. If we do see a continuation of this expectation that rates are going to be pushed out in the States, I guess there's more dollar strength, in which case we do look at a weaker and a short euro-dollar position.
I agree. That's the chart I showed before, right? So what we're looking at is euro-dollar, as you say, the mother of pairs. It's just the inverse of what I showed before. So euro-dollar going lower is the dollar index going higher, is basically, for lack of a better term. And I agree. I mean, I see no reason why we can't get back to the October lows. To me, it's a question of time. Now, we have a huge divergence in sort of posturing on fund managers. Some people, it's the soft landing versus no landing versus hard landing situation. And a lot of that's going to depend on the direction of things here. But I think the dollar remains a better bid. And then I think you see euro dollar continue to weaken lower towards, the 105-ish. We can go to the penny here, but I think that's kind of where this is likely heading over the course of the next, couple of months or so. I wouldn't be surprised.
Okay, let's shift on to gold. We always like to talk about gold only because it is one of the most talked about areas of the market. And for me, it's not doing an awful lot. I mean, with this breakout of the dollar, we've not seen any sort of major downside for gold. But nonetheless, it certainly seems like there are those that want to sell but don't dare do it, given the geopolitical situation. Let's discuss this area of the market.
Yep, very much ties into what we just said before. So from a longer term perspective, and to me, longer term here is a few quarters. Gold. This is the long term weekly chart. This is gold futures. I have no doubt that it has a good chance of going higher. What we need to understand, though, is that gold reacts to real interest rates. In this case, we're talking about real interest rates in the United States. So in order to get real interest rates, we have to get basically the direction of the dollar right, which means we have to take into account yields. So it gets us right back to that conversation before. So basically with yields, as you and I just said, expecting to remain somewhat bid, meaning maybe a bit higher, that means real interest rates, all else being equal, are not going to go down in the very, very near term. So gold, unless something totally changes, is going to have a very difficult time breaking out with yields remaining sticky. If bond yields start to come off, either because inflation really is no longer a thing, which it's maybe a little bit less likely, I would argue, or because something happens in the economy that is not something that people wish for, and the expectations of rate cuts go up again, then bond yields will come down. I know this has been a mouthful, but then gold will have a chance to break out. So I'm looking at 2100, so 2100-ish. Draw those lines with a crayon, not with a pencil. Is typically the way I would look at gold. But 2,100 on gold futures, this is spot basically. That's kind of where you want to draw your line. But again, it really depends on the dollar and rates. So that's, I think, an important nugget that a lot of retail investors don't take into account. They look at a lot of technicals, but those technicals are based on other, bigger factors in the market as well.
Yeah, you brought up a chart of the S&P 500 along with that US 10-year Treasury yield chart. And you mentioned then there was some stocks which are just driving this. And it's this, what are they called, the Magnificent Seven. I just looking at the Nvidia chart, I cannot believe how high this is going. It's entering a territory that no one really understands yet, to artificial intelligence. And it's a fascinating area. No one knows where it's going to lead, but Nvidia certainly seems to be one of the poster boys for this particular sector. But if you look at the others, Amazon, Microsoft, Google, Apple, all the big ones, they're either holding on to recent gains or they are striking new record highs. And it is only this sort of small corner of stocks which are really pushing the markets up, as you rightly said. But just to illustrate it, if you can, with one of these stocks and one you want to talk about, because there doesn't seem to be any limit to the amount of money people are willing to spend on buying into these products. Sure.
It's the escalator up, elevator down. Maybe the express elevator down is likely how it's going to resolve. And that's not a long-term negative call on Nvidia, but Nvidia correcting 10, 20, 30% is garden variety. Like, I think people have forgotten that. And that's typically how it ends. You get whether it's earnings or something but I want to quickly touch on here, Jeremy, is the correlation between Nvidia and the S&P 500. It's essentially one. So the Nvidia here is a candlestick chart. The S&P is in orange. Whenever Nvidia stops going up, it's going to be nearly impossible, just mathematically, for the S&P to hold those gains as well. But if you look at Nvidia, and this is quite interesting here because I just did a study on this in terms of volume as well. We're having what I would say is an extension move. So we had a trading range in Nvidia from, let's say, August to about early January of this, so last August to about January, we broke out. And if you take that range and extend it above the range, you get to a level we were at about a week ago, about 628, 630. We've since had an extension move. If we look at this, though, from a divergence perspective versus momentum, and I'll just show you here versus the relative strength index, which is a popular thing to look at. Particularly on the weekly chart, we're actually seeing divergence. So I'm going to quickly show you the weekly chart so you can see this. So we're actually seeing RSI making a lower high so far versus relative strength breaking out. Furthermore, and goes into playing to some people who like to follow volume. I'm not a huge volume guy, but I think it's interesting. We've had about 30-40% above average volume over the past 2 trading days in Nvidia as we extended higher. And we haven't seen that kind of a surge until we had a breakout, since we had a breakout, an actual true breakout in early January. Typically, these kind of volume surges correspond with near-term market tops like we had in November in Nvidia and we had in August. And in each one of those cases, Nvidia corrected roughly about 10 to 20%. So Nvidia correcting 10 to 20% from here wouldn't even register anywhere. This is not a negative call in the stock, but you have to do the math on what that would mean in terms of forced selling for other portfolios. So we're entering treacherous territory. Of course, I've been saying that for weeks and weeks. However, it typically doesn't end softly. It typically ends very quickly, and then you have kind of like a churning for months or quarters.
Yeah, but how much is that? I mean, it's difficult, isn't it? The age-old question is when is a turnaround,
yeah.
Or is it just a small retracement in what is otherwise a market that continues to go up?
Yeah, and so
it's a very difficult question to answer, but do you have an answer for it?
No, it's a very good question and a very difficult question to answer. However, you have to take it step by step. You do, in this case, have to start with a trade, and then you measure it, and then you measure how that is reflected in the broader market, and so on and so forth. There is earnings coming up with Nvidia as well. It's the last one of these we only have a few mags left. There's no longer 7. We're closer down to like 4. On the 21st of February, so in about 2 weeks' time. So that'll be probably the date we have to look for. That coincides after options expiration for the month of February as well. So that'll be a pretty critical date. Of course, the question is whether the market's going to top up before then. I don't know, but we're getting very stretched. You have to start it with a trade. It's impossible to say this is the top for Nvidia for 2 years. Who knows? You start with a trade and you measure and map it. That's the way we're approaching it right now.
Yeah. Just want to follow up on one other area of the market. Before we went to air, we did discuss about some of the topics to look at, and UBS came up, and I thought it's a really interesting area of the market. We've seen banks generally take a hit. In fact, BNP Paribas was particularly bad this week, but UBS seems to be a standout. And if you look at the American banks, you've got problems at companies like Bank of America, Citigroup, but JP Morgan, a standout there as well. There aren't many banks, but all of a sudden you get this little gem, and UBS seems to be one of them. Technically, how are you looking at that chart?
Yeah, I agree. I mean, to me, I'm JP Morgan is my alma mater, so I am prejudiced there. I think that the UBS is turning out to be what I might refer to as the JP Morgan of Europe. It is quite staggering what they've accomplished, and the implementation of Credit Suisse is a further boost to them. I think what we're seeing right now, honestly, is really just a retracement. And going into earnings, the stock had a big run towards the end of the year. I would probably more than anything be a buyer here once we get towards the lower 20s. It's in consolidation mode right now for sure. Again, earnings yesterday, stock buyback that Sergio announced yesterday or the day before, I can't remember. So we want to be a bit careful here about just blindly buying it. But to me, this is one of the stocks that I have no problem buying on weakness here. I think we need to see a bit more, because if the broader market unwinds and we see a little bit of correction in the broader market, something like UBS, just by correlation definition, will probably mean revert as well.
Yeah. Okay, Serge, time has beaten us. Thanks indeed for your time this month. It's been interesting to talk about what's going on in the market. It's interesting to see what happens in a month's time, whether not all these things will have unwound. We'll have to see what develops. But in the meantime, thanks indeed for your input. That's Serge Berger from the steadytrader.com with today's Chart in the Markets.